Hey folks, this is Clayton Collins, your host for the Housing News Podcast and CEO at HW Media. Today we're kicking off a special series of podcast episodes. They're special because we recorded them in person at HousingWire Annual, HousingWire's big annual event, which we hosted in October in Austin, Texas. Next year, we're bringing our big annual event to April, and we're rebranding it and calling the event HousingWire The Gathering. So stay tuned for more information on HousingWire's in-person events, The Gathering. Today, I have a special guest. His name is Nate Levin. Nate is an incredibly talented, exciting, and experienced prop tech and real estate technology investor. In this conversation, we talk about the current market dynamics in venture capital investing and private equity investing. We tie out those perspectives, not only what investors need to understand, but also what operators and users of these technologies need to understand. Nate shares his path into becoming an investor in this landscape and a lot of current market dynamics that are really important as the market goes through an evolutionary change. I hope you enjoy this episode with Nate Levin.
All right, we're here at HousingWire Annual, and I have the pleasure of sitting down with Nate Levin. Nate, welcome. Thank you for joining us.
Thanks for having me.
All right, so we initially crossed paths through your venture investing activity in the prop tech space through Parker 89. You've had a deep repertoire of expertise and experience advising CEOs and investing in prop tech companies. Tell us a little about the career path that led to this specialization in prop tech.
Yeah, well, it was, I guess, very unorthodox in the sense that I studied history, so nothing related to real estate or finance or any of the stuff that I do today. But then went into technology shortly after I graduated. My first job was with Siemens Venture Capital, a big German company. Went to then work operationally for 3 different startups. One we spun out of MIT. It was a database company. One in enterprise workflow software. One in cybersecurity and telecom. And then started venture investing. So worked with the lead investor in those companies. Realized I loved having my hands in multiple things, like learning from these CEOs, getting to interact with them and help them grow their businesses. But also wanted to actually spend time in more of a structured environment. So went to Boston Consulting Group and spent 4 years there. And there I worked with, my first project was with First American.
Okay.
And we actually built Endpoint, closing and title company, which is First American's digital title business.
That's really so First American tapped BCG to like help with development of Endpoint, something they knew needed to happen, but they weren't able to bring to market internally without support, or is that kind of how they
Exactly. So I worked for Digital Ventures, which is Boston Consulting Group's digital arm, right? And so we incubate businesses for clients. And I learned a ton through that experience about the housing ecosystem and mortgage markets, et cetera, and ended up specializing in that over my career at BCG. Worked for a number of other financial institutions and banks and secondary markets players involved in mortgage securitization. And we looked at a ton of opportunities in the housing ecosystem. And through that experience, I realized, well, consulting and advising is one thing, but actually investing in those businesses is another. And so I wanted to take the previous part of my career and combine that with what I learned about the housing ecosystem. And that's when I went to First American, built Parker 89, and deployed around $500 million ultimately in venture investments.
We have that type of career decision in common. I was an investment banker on the advisory side, and doing a lot of media deals. Loved the challenge and access of investment banking, but was so intrigued by actually putting money to work and being the investor and then the operator
versus just the advice. Yeah.
So I definitely see the intrigue of moving across the market as you gain more experience and exposure. So if we think about the prop tech and real estate technology space over the last 5 years, what have been the themes that have been important in your investing activity as we look slightly in the rearview mirror? Then we'll look at the future.
Yeah. I mean, like I said, when I was consulting, I got the chance to look at the broader housing ecosystem. And so there were a bunch of theses I had developed from that work that I knew I wanted to invest in. So one was mortgage software, right? A lot of the mortgage software is outdated, and there's a big opportunity to use modern design principles and technologies to just make that process 50%, 75% more efficient. So invested in loan origination software, invested in capital market software, and that was an obvious area. The second area I think was exciting was looking at the transaction and how the agent part of the transaction could be optimized, right? So building technology to make it easier for agents to serve their customers, to connect agents to other parts of the process. We invested in some tech brokerages that kind of owned more of the entire transaction experience, and were able to optimize that through the technology they built.
Really interesting. Okay, so here we are in fall of 2023. Last 12 to 18 months have been volatile, to say the least.
Yeah.
That's impacted players in the industry, but it's also impacted the flow of capital. We've seen less funding rounds. We've seen lower valuations. Give us a glimpse into how venture-backed companies in the market today are operating and dealing with the market dynamic that they must work through.
Yeah, I mean, the name of the game is, if you're a transaction-based business model, which most of them are, it's to save cash and try to grow if you can, but ultimately look towards when times get better. And the market's going to rebound. We know it will happen. We just don't know when it will happen. And I think that's what makes it really difficult for most companies in proptech right now. So maintain cash, try to raise more money on future growth prospects.
Future growth prospects. This is the really tough part. When you're showing a business.
But we all know that this is a huge market, right? And it's going to rebound. And so I think you do need to ask investors for more trust if you're a startup CEO right now. Hey, we didn't maybe meet the aggressive growth plans we'd originally put in place, but we do have XYZ traction that show we have real product market fit, we have fundamentals, we have real unit economics. So those businesses, even if they're not growing as fast in this environment, there's still opportunity, and there's still opportunity for them to get funded. And then if you're a software subscription-based business right now, you're in the best of situations because you've got locked-in subscription revenue that ideally you can continue to grow and is much more predictable, right, than transaction-based revenue. And so those companies are still doing really well, and they're able to raise. And I think it's the more capital-intensive business models that are hurting the most.
The business models that had the distinct OpCo and PropCo, where acquisitions needed to happen. Okay.
I mean, some of them separated OpCo, PropCo. Some of them had them together, right? I think that was a big mistake for a lot of those businesses. But ultimately, yes, having a big balance sheet, not the greatest time.
All right, so Nate, what advice would you give operators and entrepreneurs who need to go back to raise capital, whether it's for growth or cash or acquisitions? Like, how do you guide operators on managing the narrative, managing the story about, like, hey, these are the things that are working really well. We've had this headwind, but like, what's the narrative there?
I mean, part of it is the story, right? Like, look, you can craft a strong story even if maybe you don't have the growth, but you have great unit economics, high gross margin, software subscription business, those things. But part of it is sometimes just the business model it's a hard business model for the environment we're in. And I think that's where companies have to get creative and pivot. And I'm seeing a lot of that in the market right now is businesses who maybe started in one direction, let's say mortgage origination, and moving into another direction, like more marketing or lead gen services, which are obviously more highly valued right now and very hot because people need those leads. So look, a great company has to be adaptable. They have to be willing to pivot and make changes. And this is truly testing that.
All right, so if you're deploying capital today or starting the next great proptech or mortgage tech business, where are you focusing your energy? What's the vertical? What's the niche? What's the solution that needs to be invested in today for business success, but also capital return?
Yeah. There's a couple areas in proptech I think are exciting. The first I'd say is I do think there's still an opportunity that's really exciting in mortgage technology. But what I would say is it's more for kind of point solutions, right? These are things like automated underwriting systems, OCR, NLP on documents, things that will have an immediate effect on the unit economics of the business.
So on those types of point solutions, how do you differentiate between what's a point solution that should be a standalone business and what should be a feature inside of a larger suite?
It's a good question. I think that, many of them should probably be features inside of larger suites eventually. But that doesn't mean you can't build, 100 million ARR business or something like that with some of these smaller solutions in mortgage. There's the core systems in mortgage software like LOS, POS, capital market software, servicing software. Then outside of that, you have a ton of different other areas where there's still value buckets. They're just not as big. And it might create more or require more of a consolidation approach to get the kind of venture returns that most investors are looking for. And I think this is why a lot of venture investors might pass on these opportunities because they seem a little bit smaller. But I think they're some of still the most exciting in terms of opportunity to grow immediately. So that would be one area.
So we're at a stage in the market where proptech still feels like there's a lot of digital evolution to happen, but we're in a mature enough industry where we're not just talking about venture capital, early stage, or private equity deals happening in the software and technology space. So how do the markets differ between what we're seeing in tech or VC valuations of funding versus what private equity is looking for in this market?
Yeah, I mean, So I would have thought private equity have been a little more active than they have been by now, but I think most of the PE shops are waiting for valuations to correct a bit more. There's still a lot of hangover, I think, from the valuations we had over the last couple of years. But I think a lot of PE firms are waiting on the sidelines to see when those valuations get more reasonable. If they can acquire some of these businesses, if they can do some roll-ups or take some more legacy let's say mortgage software, real estate software businesses, and do acquisitions of some of these newer tech companies for reasonably priced valuations and merge them together. So they are waiting, but it may not be for another 6 months or a year or even longer until those valuations come right.
If we're thinking in valuation in terms of multiples and private equity, you can pull one of two levers. Like we can either believe the growth forecast and value off of next 12 month or even a further period, or we're going to pull down on the multiple. So where do you see more pressure in deal making? Are people putting pressure on the multiple? Is it on the P&L assumptions? Where?
It's a combination of the cost side and I think the growth side. Like the firms that I've had conversations with, I think are looking at how do we make it more efficient from a cost standpoint, and that they have standardized playbooks to cut out a lot of those costs. But also, what are acquisition opportunities we can use to grow the value chain in a lot of these businesses? Because look, in real estate, one of the biggest challenges is getting those sales connections into the entities you're selling to and those distribution networks. Once those are established, then it's a no-brainer for a lot of businesses to sell more products and services. So I think they're being opportunistic about that. They're looking at technology replatforming for some of the older school technology companies that are out there.
Okay, that's interesting. So Nate, what's next for you? You've recently made a career change. I know that you're looking at different market opportunities and venture. We just talked about some opportunities in private equity. Where does your attention go? What do you want to do professionally?
I think there's a lot, it's in crisis, there's opportunity, right? And I think it's just a really exciting time for this industry. I still believe in the potential future value of this industry. And so, like you said, I'm looking at investment roles. I'm looking at operating companies. But ultimately, we'll see kind of how, and also my personal life, where I want to be based and those kinds of things play into it. But I think it's nice to have this opportunity in your career to do a little bit of reflection in such a pivotal time, right, in the industry, 100%. and make a concerted choice about where I want to be. So,
Nate, thank you for joining. Thanks for sharing your expertise. I've loved following your investing career path. I'm sure there's big things to come.
Thanks, Clayton. Appreciate it.